Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hi everyone, it's Tuesday the 7th of September. Price action within G10 FX has been $1 underperformance, but can that persist? This is the Weekly FX Navigator and I'm your host, DJ Cheong. And in this episode, I am going to address where the dollar's going to go after the latest US job numbers and how that fits into a dollar smirk framework. So we've talked about this framework in April earlier this year, but here's a recap. It's basically a tweak on the dollar smile, where the dollar usually outperforms either in a global risk-off environment or when US growth outpaces the rest of the world. These are the left and right-hand sides of the smile respectively. So with the Fed's new average inflation targeting framework, US interest rates will likely stay lower than usual, which should weigh on the dollar via inflation-adjusted rate differentials. Now that's basically it. Now, what have we been seeing in FX markets lately? Well, it's really been about dollar weakness over the past few days. The main catalyst for that? A significant miss in US non-farm payrolls. But if you look deeper into the details, the report wasn't that bad after all, with upward revisions for previous readings, while US unemployment remained flat at 5.2% and average earnings also surprised to the upside. Now, in our view, weaker numbers are a function of worker shortages rather than weak demand. Unemployment benefits, which have been paid out by the US government, have also discouraged people from looking for jobs. Side note, Powell's tone at the Jackson Hole Symposium is also less dovish than it seems. The apparent acceleration of the planned taper pace likely reflects the Fed's desire to extract itself from the market, and it is probably a recognition of the problems around QE and financial plumbing. Now, what can we expect ahead? In our view, last week's broad dollar weakness theme could persist in the short term, but we believe it isn't wise to write off the Fed announcing a taper in September just yet. Having said that, we believe dollar gains will likely be capped by the Fed's average inflation targeting policy going forward. And in other news, we have upcoming RBA and ECB policy meetings where markets are also focused on tapering. With regard to the euro area data surpassed expectations with rising German factory orders and still solid Centix investor confidence readings. There are growing expectations that the central bank will start to dial back its asset purchases soon. That should essentially translate to euro-dollar gains in the lead up to the meeting, but we expect some profit taking prior to the announcement itself. We expect 119.10 to be tested again and see key support at around 116 to 117. Now, on a side note, for the Australian dollar, the currency has been propped up by improving sentiment in FX markets with increased prospects of implementing a taper at the meeting later today at around 12:30 p.m. Singapore time. Another choice for the central bank would be the decision to flexibly reduce bond purchases, which should offer them some leeway in terms of communication. In our view, risks are skewed towards a dovish tilt as domestic COVID-19 developments continue to worsen. Although vaccinations will continue to be ramped up, they remain far off compared to other developed economies like Canada and the UK. Immediate resistance is still seen at 75 cents against the dollar. On that note, this brings my monologue to a close. If any of these thoughts have piqued your interest, I would suggest heading to sc.com and look for the tab titled Latest Market Insights. If you're a valued client of Standard Chartered, get a hold of your relationship manager to find out more. If you've liked what you heard, remember to like, share, and subscribe. We'll see you on the next episode. Bye-bye.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.